Hello everyone, good morning. Okay, so maybe we can start. So good morning everyone and welcome to today's webinar, Boost Your Scale-Up Journey with EIB's Venture Debt Instruments. We're thrilled to have you join us today. Before we dive in, a few housekeeping notes. This session is being recorded, so please keep that in mind throughout the whole webinar. My name is Carl Miranda and I'm your host for today's session. I'm an innovation consultant at EURA, one of the proud partners of the EIC Scaling Club. Also, we encourage active participation throughout the webinar. Please feel free to drop your questions in the chat at any time. There will be a dedicated Q&A session later, where we'll address all your questions. Now, let's get started. It's my pleasure to introduce our first speaker, Agnieszka Stasiakowska, Head of Sector at EIC Business Acceleration Services at the EISME. Agnieszka, over to you.
Thank you very much, Carmo. Good morning, everybody. So it's my pleasure to welcome you today on behalf of the European Innovation Council to this third EIC Scaling Club webinar on various scale-up related topics and support offered by EISME, but also by our partners. So as you know, the EIC Scaling Club mission is to help you, the top scalers in strategic fields, to grow into European tech champions. So for this, we need minimum 3 things. And if I could have my first slide, please. Thank you. So first and foremost, we need you. So we need innovative companies with passionate and bold people behind to really steer your companies to success. So in the Scaling Club, we have selected 120 Europe top scalers with a clear goal to reach 1 billion valuation. And having such a great number of attendees today, I'm sure that you're all very much dedicated and committed to really throw this way forward. If I can have my next slide. Thank you. But what we also need is a very well-connected ecosystem, embracing and pushing forwards the most innovative companies. And this is what we are trying to do with the EIC Business Acceleration Services. We want to offer you the best possible contracts, the best possible contacts, and the skills you need in order to grow. And this is, of course, all available to EIC Scaling Club members. So both companies that are EIC funded, but also those that are not EIC funded, you also have access to this EIC Business Acceleration Services. In terms of contracts, what we are offering is matching with large corporates, with investors, with innovation procurers, and we also bring companies to the trade fairs within and outside Europe. So this is a very attractive offer, and I really encourage you to stay tuned about any new possibilities and events that are being organized from our side. And if I can have my third slide, what of course you also need to success is capital. So this is why within the EIC in EIC offer, there's of course the EIC Accelerator, and some of you receive this funding and those companies that are not yet EIC, this is also available for you to benefit from this calls. But the great novelty is, of course, the EIC step call that makes available for the scale-ups in Europe funding rounds of 30 million euro investment from the EIC side, and of course the idea is to crowd in private investments and to target total rounds of a value between 50 and 100 million euros. So this is a new call. There was recently an information session about this organized for you. The call is open, so I very much encourage you to apply for this opportunity as well. So having said all this, well, the EIC offers this funding opportunities for you, but there are also others complementary initiatives like the EIB Venture Debt, and this is why we gather together so that you get first-hand information about how to benefit from this opportunity, and also to hear from a company that successfully gathered this venture debt funding, what was their pathway towards that. So I would like to thank François Godet from EIB for accepting our invitation to present the EIB Venture Debt Program. So I wish you a great info session today. There will be questions, of course, possible with all the speakers, so I really encourage you to take the most out of it. Thank you very much.
Thank you, Agnieszka, for those insightful remarks. Now, it's a real pleasure also to be here with you today, such a talented group of innovators and leaders. Your hard work and big ideas are also shaping our future European innovation. At the EIC Scaling Club, we know that growing a business is both exciting but also very challenging. That's why we are here, to guide you, to connect you with the right people, and to also support you to your success. So let's jump in and see how the EIC Scaling Club can help your business grow and thrive. So the EIC Scaling Club is designed to provide the resources and networks and the opportunities you need to scale. Here is how we do it. So we provide tailored mentorship to guide your journey. We give access to other programs for scaling businesses, workshops and events with industry experts, custom expansion opportunities, and increased visibility to engage with key stakeholders. Our aim here is also to help business succeed across Europe and drive innovation. Securing the right funding is critical it's critical to scaling, and the EIC Scaling Club can help you through the EIB, so the European Investment Bank also, and we connect the deep tech companies with the right financial support, ensuring access to the venture debt for growth. Now, let's go a little bit more into also today's session. The EIC Scaling Club, as I said before, can support you by connecting you with the European Investment Bank and with the right team to support you in this growth. François will guide us through this important topic and share this valuable expertise. So without further ado, François, I will give the word to you now.
Thank you, Miranda. Miranda, I had a little technical problem with my computer. I'm taking the call from my phone. If you wouldn't mind putting up...
I will share the screen.
Hi, everybody. Thank you very much for taking the time to hear about our venture debt product. My name is François Godet. I head a small team of investment officers at EIB that are focusing on what we call the clean tech. I will walk you through our venture debt product, which is not only for clean tech, but has a broader remit. But first, I would like to put it in the context of EIB. You could move to the next slide. For those of you who do not know EIB, it's very large multilateral institutions governed by the EU member states. Its focus is on climate. And in the next slide, you will see of if you can move to the next slide, please, Miranda. The magnitude of the investments that are done every year by the bank. These are the 2024 policies, and you will notice that your kind of clusters in the scaling club are can find themselves into the different policy areas of the bank. Next slide. When we come to investment in startups like yours or scaling up, you need to think of the EIB group in kind of with two drivers. You have the EIF on the right-hand side of the slide. The EIF does the equity kind of investments of the EIB group through funds. So many of your funds are recipient of European Investment Fund resources. As an LP, it invests in funds that then can participate in your funding rounds. On the left-hand side, you have the EIB, the European Investment Bank, where I sit, where the venture debt product is deployed. And this is the direct investments. So it is not through vehicles, it is direct investments. We always look at projects themselves, at your technology themselves, and at companies directly, not through intermediaries or funds like the EIF. If we go to the next slide, I think I can, with this slide, it helps you kind of position where our venture debt product is meant to position, and who is the venture debt product for. So it is for people that have started fundraising, that have gone through a Series A or more likely are into a Series B, as a lot of you are. You have to be in a an organized growth kind of business model where you're aiming at growing and you're fast growing, and you have a business plan that is sustainable. So why do I mention this? It sounds very obvious, but venture debt is debt and is not grant. It needs to be looking at a business plan that has prospects of repaying the debt, but also servicing the debt over time. So that's quite important. And the key driver of the product is really innovation in the different subjects, but really not doing more of the same, but being in an area like changing the game for the areas that you're developing your technology. So quite complementary to what the EIC does. It is on a range that I would say starts from technologies that are developing their first of a kind demonstrator, sometimes pre-revenue, getting to the market, all the way to pre-IPO scaling up type of ventures that already have revenue, that are tracking their market, but that need substantial capital to address their market. So quite a wide range of companies, but definitely companies that are innovative growth, that already are starting to raise capitals, that have the governance to go with it. And one question was, where is that remit of venture debt? Well, at this point, it is for companies and projects that are based in the European Union, plus Iceland and Norway. In the past, the product was deployed in Switzerland and Israel also, but now in this programming period, it is focused on the European Union plus Iceland and Norway. If we go to the next slide, please. So the areas that are relevant are really, really close to all the subjects that are in the Scaling Club. We have a lot of innovators in the Scaling Club and in a lot of verticals that are relevant. At EIB, there are 3 teams that are deploying the venture debt product. One is focused on what we call the deep tech. So it includes engineering, manufacturing, robotic processes, and ICT. So all the supercomputing, all the robotics, automation, new industrial processes, software solutions are with that team. And we have a life science team that focuses on biopharma, medicine equipment, and the likes. And then if we move to the next slide, we have the broad sectors of clean tech, the team that I work with, which focuses on new energy solutions. So everything on batteries, on battery chemistries, battery components, new types of renewable energy or renewable energy innovation, management of infrastructure, so grid solutions, mobility in all its form, road, air, maritime, logistics, their infrastructure, and also the alternative fuel that are required to drive the transition in mobility. We have quite an interest in circular economy. Circular economy is a great contributor to climate solutions. So circular economy in all its forms, so be it for plastic, for metals and critical raw materials. And then we have people that are focusing on bioeconomy. And we also are trying to support the deployment of solution for the decarbonization of industry, so what we call low carbon solutions. So if you look at the Scaling Club, the EIC Scaling Club kind of clusters, you can easily map them against our teams and focus with the venture debt product. But now let's look a bit at what is that venture debt product in the next slide, please. So what is the venture debt product? Well, it's a bit in the name. It is debt. And why is it debt and EIB not doing equity? Is because at this point, our statutes does not allow us to deploy a direct equity product. As I said, indirect equity is deployed by the EIF. We are doing direct investments, and we're not allowed to do equity. So we've designed a debt product, but it's really a debt product that is meant to be a complement to equity. It is a debt, we call it internally a quasi-equity product, because it is really meant to complement the equity and be more on the equity risk scale than definitely on the commercial debt offering. The product, as you saw from the eligibility, is really addressed to companies that are, early stage, sometimes pre-revenue, early deployment, early revenue, or high revenue growth that do not have the track record required by commercial lenders to provide corporate lending. So they rarely have access to leverage. And the venture debt product is there to kind of bring or bridge the gap between the full equity kind of financing source and the commercial lending that is not yet available. So it's in the journey in between, where growth required quite a bit of capital, and therefore we're trying to alleviate the level of equity required. So what we're doing is we're providing a debt, and we're looking at an investment plan that is, very often quite long compared to what equity holders are willing to finance upfront. So we're looking often at a 3-year investment plan where we scope the investments that are likely needed by the company, and we size the debt on that 3-year investment plan. We don't give all the money up front. We will usually tranche it to allow the company to have visibility on accessibility to the funding, but tranche against milestones, which contrasts a bit to, for those of you that are, going to shareholders to raise capital. Very often shareholders kind of want to limit it to, well, I'll give you this capital now, and then you come back and we'll see how you're performing, and we'll give you the capital later, or not, based on their capacity and the performance. We try to give companies visibility for kind of a number of years of quite significant amounts. Our tickets are usually 15 up to 50 million, but as I said, tranched, and that means that we need to have in front of us investment plans that are double that size. So that's why we also look at 3 years investment, because we know that's quite significant investment. And then when you look at, okay, we have the investment plan, we have the sizing, we have the tranches with its conditions, then, it's deployed, and how does it repay? Well, it is the nature of the companies that we have in front of us for the venture debt product to have developing business plans, and business plans that are, cash flow negative for a period of time. They are in their growth phase. They are in the deployment phase. They are in a phase where they need to conserve their cash or not, they don't have the cash flow for serving the debt. So we often have bullet structures. Although if we see in the business plan that cash flows are coming in, we will often try to sweep them so that, but we don't want to put the company in a too difficult, too tight position, because we know that the business plans are evolving over time. It is a debt, so it does have a coupon attached to it. So the interest rate is not the main kind of revenue generator, or not the main driver of the product. There is an interest rate attached to it. I would say generally it's in the mid-single digits. It varies depending on the venture, the maturity. It varies on different drivers. It can be cash if the company generates the cash to serve the interest, or it can be PIK, so paid at the end at the same time as a bullet installment if the profile of the business plan requires it. But the interest rate is not the only remunerating feature of the product. As you can imagine, an early stage company that is pre-revenue or just starting to deploy or scaling without the track record does not, the risk profile is not for a few hundred basis point interest rate. So we at the EIB with this product try to get our fair remuneration of the risk that we're taking through an upside feature. An upside feature that often takes the form of a warrant in the investee company. So we take warrants, and we are hoping that the value of the company will increase over time, and therefore our remuneration is linked to the success of the company we're financing. I think that's generally the features of the product. I'm sure you have lots of questions, but let's leave it at that as to give you the broad information on the product characteristics, and then we can take questions or we can do it bilaterally if you have more questions. I would go to the next slide. So what do we think are the advantages of the venture debt product for you, kind of entrepreneurs? Well, from a company perspective, you are, because it's a debt product, so the capital needs to be repaid. It is not invested in capital. It's much less dilutive than your normal kind of equity raise, because the dilution comes only from the warrant feature that I mentioned. It is also giving the company a bit of a seal of approval. We are quite well known in the market as a very kind of stringent institution for our processes and for our kind of assessment of the environmental impact, but also of the technologies that we're investing in. So we bring a seal of approval. We also we are due diligencing, structuring, but afterwards we don't keep a hand on the steering wheel. We're not like your VCs that will want to have a very strong position on the board. So we see these things as kind of advantages. Well, for the founders, similar advantage. We're not dilutive. We're not trying to be driving the company. We try to look at management and say if we believe in the management and then let them do their execution, so much less involving. And then for investors, we are kind of a solution for leveraging at the time that is not really possible because commercial lending is not yet accessible. So we are allowing them to leverage investments. We reduce the level of capital they need to put in. So these are kind of what we see as the advantages. And also we for both the founders and the investors, we provide kind of already long visibility on the funding. So that's quite advantageous for everybody around the table to know that if things roll out and deploy, then you will have the EIB there for quite large amounts, and that reduces the equity rounds that need to match it. I see lots of questions in the chat. I will try to take them later. If we go to the next slide. So now we're getting into the kind of the texture of that product, and you will see that it has been deployed for a number of years across Europe. We saw across a number of your sectors and verticals, and quite significantly, if you look at the volume that has been deployed over the last almost 10 years now, hundreds of companies benefited and quite significant amount of capital deployed. You'll recognize a number of names on this chart, but I have pulled out a few examples. If we move on to the next slide. Oh no, it's true. I wanted to talk a little bit about the process because process is important. It is a process that I would say if you have quality information similar to what you've provided, let's say a B round investor to reach his decision, I would say that it's longer than an equity round in the sense that the technical due diligence is more intense. We really look at the technology and the capacity and its impact. So I would say that it takes about 6 months, and it can go easily to 9 months depending on your level of preparation. usually we do a screening process. We interact with the European Commission depending on the level of risk that we're looking at. Then we move with an appraisal. The appraisal is always with kind of a dual team, which is us on the structuring front office lending side with our sector experts. And in terms of sector experts, if we talk about a battery project, well, we'll deploy experts that are, that have done most of the gigafactories in Europe and that have used that are looking at the new technologies. So we really have sector expertise in-house, which is quite a distinctive characteristics to your normal VC who, will rely on outside advisors or will try to gather some level of internal expertise, but it's very difficult if you see the number of subjects that the EIC Scaling Club covers. It's difficult for VCs to have specialties in all these subjects. And then after the appraisal, we move to concluding a term sheet negotiations, which is the basis of the approval for our financing, and that translates into legal documentation. Next slide, please. So the slides that I've used are illustrative, kind of try to take a broad number of subjects. But if you go down, and there's one slide that I don't know so this is critical raw material. The prior one was in mobility, but I would like to go down to maybe to Ineratec, which is a bit further down. I mentioned in the slides those that are EIC Scaling Club, but I wanted to talk about Ineratec quickly because it's quite recent. It was signed in December, but it's also quite illustrative of what we do. So Ineratec, for those who do not know them, they're a developer of miniaturized chemical plant for the production of e-fuels. So quite something that is quite technical in nature, and what they're trying to do is on efficiency of different known processes such as the Fischer-Tropsch reactors, and they're trying to miniaturize the chemical plant so that it be close to a proper hydrogen or CO2 source for the production of e-fuels. But so that has its challenges in capital investments. They need both to progress their technology, but at the same time they needed to fund a first large demonstration plant to show their client that here is the technology, here it works. That's for you to come and see and touch, and then for building up their pipeline. And that was quite capital intensive. And then we looked at them and gave them 40 million euro venture debt for funding the implementation of the demo plant, but also funding their research and development that will lead to their industrialization. And because we have a partnership with Breakthrough Energy Catalyst, we were able to also bring to the table a 30 million grant for Breakthrough to support not only their specific technology, but to take it one step further, because they produce e-fuels, but in a certain format, and to make it all the way to the jet fuel or e-SAF. That was another process that is not so proprietary, but that was really important for the demonstration for their client, and then Breakthrough was able to provide a grant to fund that last deployment. So I thought that was an interesting example, part of the EIC Scaling Club, a company that has quite a breakthrough technology, and where, you know, we were able to help it not only in furthering its industrialization by providing funding for the research and development of its industrial process, but also for its quite capital intensive demonstration plant in Frankfurt. So I think this is what I wanted to walk you through. I'm sure you have lots of questions, but I will leave it at that for now.
Yeah. Thank you very much, François, for that comprehensive and informative presentation on the EIB Venture Debt offering. Yeah, I already see so many questions in the chat, and I'm sure that we will have more. We will get to those in our dedicated Q&A session later, but feel free to continue posting your questions in the chats. Now, just sharing back to my screen. 1 second. Yeah. So before we continue, let's take a moment to capture this special occasion with a family photo. We'd love to see all your smiling faces, but if you do not want to appear, please feel free to turn off your camera now. For the others, please feel free to turn on your cameras and give us a big smile. All right, everyone, let's smile. We are taking many photos. Ariane, are we good?
Yes, all good. Thank you.
Okay, perfect. Thank you very much to all of you who have participated. Now, let's hear, as François already showed, let's hear a real-life success story from a company that has benefit from the EIB Venture Debt process. We are delighted to welcome Justin Spratt, Chief Business Officer at EIB, who will share his experience with us. Justin, over to you.
Yeah, hello everybody. So a little bit about me. Yeah, I'm the Chief Business Officer at EIB. I have an Australian accent because I grew up in Australia, but I've spent a ton of time doing business around the world. Currently reside in Amsterdam and work for a Berlin-based company that the European Investment Bank has given some venture debt funding to. We closed November last year. It was a really good process. I'll kick off with giving you some context on what it is that we approached EIB for, and then I'll tell you a little bit about the process, and then happy to take some questions. So we are a remote driving company. We remotely drive cars mostly, although we can do pretty much any vehicle that touches the planet. So we don't do remote controlled aerial vehicles. We do stuff that has wheels, and we've done everything right up to 18-wheeler trucks. And so our technology has been built over the last 6 years. We have 19 patents, and the rationale behind the business is to kind of decouple physical drivers from the vehicles. You know, the main use case that we have at the moment, and the one that we approached the European Investment Bank on, is our B2C service, our consumer service, which is essentially click a button, get a car, and you drive, right? So it takes a little bit to get your head around the proposition, but it's proving to be pretty interesting for us from a commercial point of view. So if you're prepared to drive yourself, we can bring you a driverless car, and it's about 50% cheaper than ride hail. So it's a price sensitive category. And it's a category that if it ends up working will be probably a lot larger than ride hail. And you can imagine this technology also being put into private cars at some point when the cost is right, and being able to be what we call tele-chauffeured, or at least, have your car driven to a service or driven to charging. There's a whole bunch of these use cases, and I'm happy to talk about it. The technology that we've built is what's known as automotive grade. So it's actually quite easy. It's not technically that difficult to drive a vehicle remotely, if it's on private grounds, and if it's a small vehicle, and if there's no safety case, and if there's no automotive grade engineering baked into that. The difficult part is making it safe, and the incredibly difficult part is making that safe for urban settings. So in other words, city driving. That's a really, really complicated problem set. And our guys have been working, our team, our guys and ladies have been working on it for, like I said, 6 years. We've been commercially going for just over a year now. So it took us about 4 years. When I first joined the business as the first commercial lead, almost 3 years ago, we had about 100 engineers and about 10 commercial people or 10 business people. So it really was massively engineering focused. And since I joined, we've been trying to build out, or we have been building out the commercial piece to the business. We managed to raise through venture capital about $100 million prior to reaching out to the EIB. And then the EIB, we actually got introduced by a company called Wingcopter, also a really interesting company in Europe. And we made our pitch into the clean tech business unit to a guy called Khalid, who was the lead on our deal. And we essentially pitched our B2C business, our consumer business. We have built out operations in Hamburg, in Berlin. We now have in Brussels, and we also have in Las Vegas in the US. So I can talk a little bit about that America sojourn as well, which is a little bit unusual. But it's entirely kind of a regulatory risk mitigation piece. So obviously the rationale, as I think you just heard, I got on the call a little bit late, but as you heard, the rationale for the European Investment Bank is to try and fund infrastructure and technologies that support the European Union's economy in broad strokes. So that's the key thing. Does your technology help drive, and the way we talked about it at VEI was, can our business help drive the GDP of the European Union in some way, shape or form? And so that's the catch-all for, obviously, does it create jobs? Do you create unique technologies, R&D and IP that sits inside the block? Yeah, and through a whole bunch of services, does that roll up into the European Union income statement or GDP? So when we approached the EIB, they were very accommodating. They're very welcoming and warm. It is a complicated process. I think it's important for me to say that because you also need to be very buttoned up if you want to approach the EIB. They have very high compliance hurdles that they have to get through, which is good. I'm not a huge fan of bureaucracy, but this is kind of bureaucracy that makes a lot of sense. They have our money, our tax dollars, or tax euros, should I say. And so they are, strong custodians of that capital, and they want to make sure they allocate it properly. So there is a high hurdle for the due diligence piece, which I think is good. But if you do that, if you manage to get through those hurdles, we found a very supportive network there and a bunch of people there that helped us build out and, battle hard in our business case and our business model based on their experience as well. So it was very supportive. Once we pitched and we convinced them that we were probably a good bet, there was a hell of a lot of support along the way. And it was a really, really good process, especially with our our deal lead, Khalid, and then a couple of the other people that were part of the team. Our process, and I think this varies, but our process took about 12 months. And I think that could be influenced by the fact that we are German. I think the German regulatory and compliance hurdle, well, I know, is definitely higher. Trying to get notaries and stuff and notaries have to be physically present, and key shareholders, shareholders have to be physically present. It's a really high bar. So that could have been some of the coordination effort. So the German companies need to probably do a little bit more. But apart from that, everything else was pretty straightforward. But in our deal, and I think most deals have warrants attached, the warrants piece can get a little bit complicated. That obviously talks to dilution and the equity bet that the EIB has in our businesses. It makes sense. It's a good incentive, but that warrant piece is complicated, and that takes shareholders a little bit of time to get their head around. But again, I think it's a very effective tool. And you have to remember that EIB. I'm not sure who that is, but
I will ask everyone to mute yourself, please.
Yeah.
Justin.
Unfortunately, I don't speak yawn, but hopefully I'm not boring the others. The pitch for us was, look, as I said, sorry, I got a bit sidetracked there, but the process, the warrants piece, I think is a really good incentive. That was my point, is that the EIB gives very good commercial venture debt lending. I mean, it's almost not venture debt. I mean, the way we talk about it with some of our investors is it's almost its own asset class, because the interest rates for a risk that that we are, they and scale up companies, is so high that if you were to price that with real interest rates, it would never make sense. And often venture debt, like commercial venture debt, just really doesn't make sense at such an early stage. So in a way, the European Investment Bank has created this unique asset class with very commercially attractive rates. And of course, they still need to make a return. And so that warrants piece makes up that return. And so I found the structure really compelling and really supportive of European tech, like incredibly. I was really, really impressed by it. So I'll pause there and I'll ask, you guys can ask some questions. I mean, we got an amount of money. It's public. It's based over 3 tranches. The 3 tranches they have an operational target. Usually, for us, I don't know if usually, but for us, revolve around raising external capital. So getting the market to price our asset, they. And then operational is around hitting operational targets. So in our case, the number of vehicles on the road. And then there's an R&D component or an IP component where we're developing unique technology that is sitting in the European bloc and help driving that economy. And so there's three tracks to each tranche. We have 3 tranches. We have to draw down all of those tranches over 3 years, 30 months to 3 years. There is a warrants piece. Our loan is 8 years. And so, I mean, all of your terms, if you end up going for this, will differ based on the risk profile of your business. We obviously needed a significant amount of capital for our business. The R&D costs are significant. So which is publicly known, we got a financing facility of 34 million euros spread across those 3 tranches. So it's got a warrants component. It took us about a year. We did it in Germany, so there's probably an administrative overhead there that shouldn't have made it go that long. So yeah, that's the summary. I'll pause there, and then I'm happy to take any questions on our process. But the 2 takeaways: one, it's incredibly good and powerful to have this. This is one of these kind of instances where the European infrastructure or the European framework is really, really powerful. I mean, there's a lot of friction at times trying to do business. This is not one of those. Having said that, when you go into the process, you need to be really buttoned up with your due diligence, your financials, your pitch, like super, super professional on that as you go through the process. So I'll pause there.
Okay. Thank you, Justin, also for your inspiring testimonial and also for sharing your experience with all of us, also as a first-hand experience. Before we move on to the Q&A, we'd like to hear your thoughts on today's session. Your feedback will help us also to improve and tailor future webinars. So please feel free to fill it out. You can scan this QR code in the screen, or a link to the feedback service. It's also now shared in the chat. I will give you like around some seconds just to catch the QR code, and then we can move on to the Q&A.
While people do that, I've gone through some of the questions that were asked online, so I will try to go quickly so that I take most of them. So yes, Horizon might be looking at Switzerland, but we are focusing on InvestEU, and that defines the scope. So Switzerland and Israel are not in. Norway and Iceland are. Can it be a complementary to the accelerator? Yes, we have a number of companies that have received EIC accelerator funding. Can it be the full co-financing part? Well, we need to look at the specific case, because obviously having, as part of our due diligence, it's about also governance. It's also about the shareholder stack. It's about a number of things. So, we are looking at a diversified, strong investor base. Having, only the EIC for a large part of the funding may not be the ideal configuration for us. Warrants, we've talked a little bit about, but what are warrants? It's basically EIB does not do equity investments. So what it does, it provides a loan. The loan has a repayment schedule, either bullet or amortizing or sculpted, with an interest rate that is either cash or peaked, so paid at the end. But it also takes, at the time that it issues the tranche, like in the Vase example, in 3 tranches. Each time it provides the lending, it receives from the company warrants. Warrants are options, if you want. Warrants are option to buy shares at a later stage. So these, because you're indirectly, or you're having the possibility to own part of the company, as the company valuation progresses, then these warrants are worth more or less money. And that's why I think it was said that it's an advantage, is that the company is not paying up front through the loan part. It's just getting giving up some of its upside future. But if all goes well and the company increases in value and is successful, then everybody kind of wins and earns. And what is interesting is that, if it doesn't go as well, EIB is also taking part in that risk, because it doesn't get the return that would otherwise have to be charged through an interest rate. How much commercial traction is needed for venture debt? Well, you definitely need to be at least, and that's for the most disruptive climate technologies, you need to be at least at TRL 6. So you need to be out of the lab, out of the pilot. You need to be on your way to commercialization. You can be pre-revenue. So, if you have a first of a kind, that's what this is meant to do, to get you to revenue. But that's where we intervene. So yes, it can be pre-revenue, but it has to be that you are ready, or you need to demonstrate that you are wanting or ready to roll out. How do we conduct the technical due diligence? Well, as I said, we have in-house expertise that is quite, targeted to a lot of the sectors that we cover. So we look at the business plan. So it's also looking at the credibility of the projections and the costing that are there. But we also look at, what is the detailed engineering design, how is the risk managed through EPC, PCM, what is the scaling factor in what we're financing, and has the company really, is it a modular serial kind of capacity increase, or is it a true step up, and how is the company dealing with this risk? So this is what the due diligence focuses on beyond the market, of course. Just going through repayment. As I said, it's really a function of the business plan. Yes, it can have, if it's either with an amortization or sculpted, it will have fixed repayment dates, but we often tend to calibrate the repayment schedule. If we see that there's room for repayment during the term, we usually take a kind of a dim view on the potential cash flows, and we put the hard repayment based on that, so that we know the business plan will fluctuate, so we don't go back at the design of the repayment schedule. But what we often do is that we put it as a low base of mandatory repayment, and then we take a cash sweep on top. Do we invest in public companies? It has happened, but it's not the normal evolution of the capital stack for venture debt to go into public companies. More often than not, you have an evolution where you start from, being seeded and then, evaluating your business plan and your technologies. And then when you reach a certain point, you IPO, because at that point you want to have, access to different capital markets. We think we're a bit more of a complement to VC in a more of a private context, but this is not a hard rule. Sorry. Yes, you can talk to the life science team. That's a lot of their business on medicines and vaccinations are at different stages of the approval and therefore of the trial. You would need to talk to that team for the details as to how they do it. It's quite specific, and I would not want to pretend to understand exactly the specificities of their business. Is the venture debt concurrent with an equity round? Well, that's a very good question. Actually, we can do it at different points in time, but as was highlighted by Jazz, the challenge is in structuring these, because of the complexity, is very often around the pricing of the warrant and the negotiations around the warrant. And if you have a reference price that is very recent, as kind of like, a qualifying round, so, a reasonable size round by a diverse and new shareholders, then that provides a bit of a benchmark as to where your value is. If that round is too dated, so too long, that kind of brings more discussion as where you are now, because there's less reference. And if we are looking at pricing the warrant, in the future, then, it has to also be a function of the future round. So it's doable, but it brings some level of complexity. But so ideally a round or during a round or next to a round is the ideal scenario, but it can be done outside of a round also. So have they generally completed a round B, or is the companies that are in, completing round A? Well, again, it's a bit of on the kind of the maturity and risk profile of ventures that are in seed rounds in round A and round B and further down the road. So we have different pockets of risk capital. Some have more support from the European Union. Some are more on our own EIB balance sheet. So to be in a Series A, we can look at it, but again, the tech needs to be of a certain kind of maturity, and I mentioned TRL 6 as a minimum. Then the other part is that it was mentioned that you really need to be buttoned up, as Jaz said. So you really need to be ready. And in our experience, although we can join or be around A, very often the company does not have kind of the maturity itself to just deal with us. So very often, when people are just seeded or round A, they don't always have the full governance in place. They don't necessarily have a CFO, which is really something that you should have in place to be dealing with us in terms of the business plan kind of discussions. But also we're a process that is not light. So if people are too early stage, we kind of suffocate them with our process. And people, you'd need somebody that has really large capital needs, and very often, round A's are more humble in their needs. And remember that we need to find a project of 30 to 80 million of investment over 3 years. So that doesn't always match. There is no hard rules on, what, if you are in revenue, what kind of leverage does that bring to you? That's not how the product works. The product works on expectations of growth rather than an immediate ratio or matrix. We tend not to take collateral. We would more often than not take collateral defensively if you have like a small kind of working capital and they are taking security. So that kind of, we're really catering for complementing the equity. So when there starts to be debt and debt that takes collateral, then it kind of brings different implications for us. But generally, I don't want to say always, but generally, we tend not to take collateral and rather require companies to give us a negative pledge, so an undertaking not to give security. There's a question on the scaling club. I will leave that to colleagues. What is the typical cost of EIB venture debt? Well, there depends what you call in cost. If you think of the interest rate, it's usually, as I said, not that high for the risk we're talking about. So I would say, as a rule of thumb, mid-single digits, but can take 3 to 7% interest as kind of a benchmark. But that's not speaking of what's the cost, because you need to think or consider in the cost the warrants, and the warrants are for different people, stakeholders around the table. For the company, it doesn't cost much issuing its warrants and its equity. It's costing maybe to its founders and shareholders. And there, what is the cost? Because you're issuing capital, so it's really on the value of today, but then you're also sharing the value of tomorrow. So the cost is a bit in the eyes of the beholder, but I would tell you that it's definitely a cost that is in the double digits. So it's very difficult to associate a direct cost to the warrant, because the warrant is not for sure. It's not a sure pricing, right? It counts on the development of the business. So as I said, it really depends. If somebody believes that company is going to be worth a lot of money, which a lot of shareholders do when we go in, then they'll say, well, it's very expensive, but then it's an opportunity cost also, and it's we're not asking anybody to guarantee us the returns. We're saying that we're willing to take the same risk. So as a benchmark, let's say that at equal business plan, the shareholders are asking as pure equity funding for an IRR projected at, say, 25%. Well, we will be short of that. We will be under that normally. Why? Because we are debt, so we have a liquidation kind of timing, and we are senior to them, and we have an interest rate. So there are a number of components that by our product kind of, dictates that we do not ask for the same return as equity, but you definitely have to think of a more of a closer to an equity-like return than, as I said, the 300 to 700 basis point we're talking about. So it's really the pricing, as I said, is really on the perception of what the value of the warrant and what is the prospects. And you need to also look at it as what are the shareholders kind of asking, and what's the cost of raising equity, because that's the alternative to the program. Okay, there's a question for Step on the conversion. I will leave that to colleagues. Sorry, and my chat keeps on pulling back.
I can support you if you want. We have here another question that it says, can EIC blended finance be paid out, matched based on a convertible loan being converted as a part of the round?
This is more for the EIC colleague, because that's not for the venture debt. Yes, it can complement the EIC grant and equity. The best contact point for EIB for venture debt, we have, if you look at the EIB venture debt page on the EIB website, there's a whole sequence of venture debt which contains a lot of the information we discussed this morning. You can open up an account and you can provide us with your case there. That's one way to do it. You can also email to me at gaudt@eib.org. Somebody can write that in the chat maybe so that people have it. Then I can direct you to the right team, but you need to provide us with at least your investor deck and kind of formulate what kind of financing you're looking at. The warrant is not converting the debt. No, the warrant is issued as part or as a consideration for disbursing the debt, but the debt does not convert into equity, or it's not a convertible in the usual sense of the term. The size of the warrant, that's a very good question. It varies a lot depending on the maturity of the company. If you are quite mature in your tech and you're really kind of in the scale-up phase where there are prospects of you soon being EBITDA positive and trucking along, then the warrant coverage is going to be much lower. But if we are looking at a company that is very, very early stage with high technological risk, then our loan, even if it's a loan and has a liquidity preference, is very close to an equity risk, right? Because there's so many things that can go wrong that even if we have a debt, it just might not come back. So in that case, what we call the warrant coverage, so the level of warrants we get in relation to the debt size. So the debt size, let's say that you're doing a round and you are worth, for argument's sake, 100 million pre-money. Then let's say that you're looking for a 20 million EIB loan. What we call the warrant coverage is if we had invested as equity, what kind of, equity would we get? In this case, roughly 20%, a little bit less than that. It's 20 over 120 post-money. So that number of shares is kind of like the denominator of what we call the warrant coverage. So should I get, 10 million worth of warrants in this case, or should I get more or less? So that's the warrant coverage we're talking about. This is really what needs to be looked into based on the risk profile of the company. When EIB wished to exercise the warrants? Well, that's an interesting one. The answer is never. We don't want to be a shareholder. We're using this product feature to allow us to track an equity value as we are not allowed to hold shares. So it's really a value tracker for the risk we're taking with the product of venture debt. And therefore, we're holding those warrants, and all we want to do is we do not want to become a shareholder. We want to monetize those warrants. And the first port of call to monetizing them is generally by asking the company to buy them from us. When we are 5-7 years out in the loan and we want to, the loan is getting repaid, at that point we would like to put the warrants on the table and tell the company, please buy back your warrants to give us the upside that we should benefit now that you are successful and on your way to greater things. And how that is done is that we usually put back the warrants to the company and ask them to pay them, giving us the fair market value of those warrants as if they were shares. So basically what we're looking at is that company that I mentioned was, worth 100 million when we got the warrants. We got, let's say, we invested, 20 million. Let's say we got 10% of the company in warrants equivalent. Comes 5 years later, the company is worth 2.5 times. So it's worth 250 million. So our warrants are now worth 25 million. So, if somebody had invested 10 million, it would get 25. Then we put our warrants to the company, say, please liquidate them for the fair market value of those warrants, which is now 25 million. And that's why we liquidate them. If the company does not have the liquidity or it's not possible, then we try to go in the market to find buyers for that asset. Or often there's an M&A or there's a transaction during the life of the loan that allows us to monetize them, and that's when we do. And yes, we usually ask for a put at maturity to liquidate the warrants.
Okay, I think that we reached the end of the questions. So thank you very much for all your thoughtful questions, and thanks, François, for providing such valuable answers. If you have any additional questions or any question that was not answered during this webinar, please feel free to reach out to us by email, and we will make sure to answer it and support you in the right direction. Before we officially wrap up today's session, it's my pleasure to invite Sarah Jude, Project Advisor at the EIC Business Acceleration Services at the EASMA, to share some closing words. Sarah, the floor is yours.
Yes, thank you, Carmo. Thank you for so efficiently guiding us through this webinar. I believe this was a very insightful and resourceful session for our company, providing us with an overview of EIB venture debt and some very practical information on its characteristics, on the eligibility, as well as appraisal process. And it's definitely good news, I believe, for our companies that many EIC venture debt focus sectors very well align with EIC Scaling Club market opportunities. With this in mind, I hope that the case studies mentioned, in addition with the advantages and potential risks, also made your consideration on the next funding round a bit lighter. Coming to ending words, I would really like to thank all the speakers who have generously shared the knowledge and their experience. First, François Godet, many thanks for walking us step by EIB venture debt, and also at the end, patiently answering all the questions that we have received. This really proves the interest into this scheme. Special thanks also to Justin Spratt from Way for sharing their experience with EIB venture debt and for making his time to join us today. I believe that this first-hand experience with detailed insight on the whole venture debt process are very welcome for our companies. Also, thank you for participants for actively engaging and openly stating your questions. As mentioned by Carmo, we remain open to receive your follow-up questions and dispatch them as needed. As well, questions on STEP, since this webinar was dedicated to EIB, please do approach us with questions on STEP, and we will have a look into them to answer them appropriately. Last but not least, so many thanks to the EIC Scaling Club team for your dedication to support Scaling Club companies. Before concluding, two more calls for actions, if I may have the next slide. We will continue with the series of webinars, but to make our support more relevant and really tailored to your needs, I echo Carmo's invitation and kindly ask you to provide your constructive feedback and honest feedback. Of course, it will take you less than a minute. Please scan the QR code here or access the questionnaire via the link that has been just shared in the chat. Your feedback will really help us to improve our service. And talking of next webinars, I'm pleased also to mention that we have the next webinar, Spin for EIC, coming up in exactly 2 weeks. So make your agendas free on morning of Friday, 7th March. This webinar will be a great opportunity for you to learn more about the EIC innovation procurement support opportunities that we offer in EISMEA, both for EIC and non-EIC awarded companies within the EIC Scaling Club, and we have dedicated support both for sellers as well for buyers. So we will keep providing webinars to share insight on the actions that we have here for you to support your acceleration. But it's up now to you to take this knowledge, align it strategically with your business goals, and indeed make it work for you. So once again, thank you for joining us today.
Thank you so much, Sarah, for your words, and we look forward to seeing you at our future webinars. Wishing you all a fantastic day ahead.
Thank you. Bye-bye.
Thank you.
Thank you.
Thank you.
Thank you. Bye.